Hello, our beloved students and learners. It is teacher Shoppi Eria from Muna Education Services. I welcome you all to our lesson today. And today's lesson, I'm going to be covering cash flow statements. They are also called cash budgets. It is one of the financial statements. Remember, we have three financial statements. In my previous lessons, I covered the income statement, the balance sheet, and today I'm going to be covering the income statement. Is also called cash budgets. Okay, we have cash flow statements or cash budgets. Now, under the cash flow statements, it is defined as a financial statement that tracks cash transactions in a business in form of cash inflows. Cash inflows also mean cash entering the business, and cash outflows, it also means cash leaving or moving out of the business in a given period of time. Now, under the cash flow statements or the cash budgets, businesses track their transactions in form of cash inflows, as in money entering the business or money being received by the business, and the cash outflows, the money that is being spent out by the business on the different transactions in a given period of time. That is a cash flow statement. Here we only look at cash transactions, money entering the business and money being spent out of the business. Okay, that is our definition of the cash flow statement. Okay, now we have the components of a cash flow statement. The components of a cash flow statement. Now, under the preparation of a cash flow statement, we always have these components. One is called balance brought down or balance brought forward or balance brought down. They're abbreviated as B/D or B/F. Now, the balance brought forward or balance brought down, also abbreviated as B/D or B/F. It refers to the amount of money or cash that is carried on or transferred at the end of a given month or period to the next financial year. Balance brought forward means the previous money that remained that is carried on in the previous month. Let's take an example. This is the month of December 2025. The money that is going to be made as profit in this year is going to be carried on in the next year. That is called balance brought forward or balance carried or balance brought down. Okay, that is the first component. When we are preparing a cash flow statement, that is what we first write. It is called balance brought forward. Okay, then we have what we call the cash inflows. The cash inflows. The cash inflows refer to the incomes to be received by the business from all its operations. Businesses do different operations that make them receive money from their operations. So if a business receives loan, that is a cash inflow, meaning money is entering the business or the business is receiving money from other businesses, and so it is recorded under cash inflows in a cash budget. Then we have what we call cash sales. Cash sales means the cash received from business selling out its goods or services and other operations. Then commission received. Commission means that money received by business people for rendering good services. This is always most common in telecom companies. Talk about MTN, talk about Airtel and those other UTL. So they pay their agents using commission. That the more transactions you make, they give you a commission. Okay, that is also a cash inflow. Then we have what you call rent receivable. This is mostly the incomes received by landlords from their tenants. Take an example: you own rentals and then you receive rent from your tenants. That is what is called rent receivable. Then we have what we call cash at bank. Then there is cash at hand. Then sale of fixed assets for cash. that is all recorded in cash inflows. It is recorded under cash inflows when preparing a cash flow statement or a cash budget. Now we have a note here. Note: all transactions that bring in cash into the business are cash inflows. Remember, we're talking about cash inflows. Anything that is not to do with cash is not recorded under the cash flow statements. Anything that is not to do with cash is not recorded under the cash flow statements. Now, the third component of a cash flow statement is called a cash outflow. Cash outflows. Now, cash outflows mean these refer to all the incomes spent out by the business for purchases and payment of all business requirements in a given period of time. Any money spent out of the business for purchase or payment of any business requirement is called a cash outflow. So we are going to be seeing examples of transactions or expenses. So any expense made, any payment made is called a cash outflow. So we are going to record that in the cash flow column. Okay, then examples of cash outflows in a business, we have some of them. I just put some of them here. We have what you call expenses, and those expenses must be cash. So cash purchases are outflows. So we are going to be seeing transactions where we have purchased goods and some other paying off some other expenses. We are going to be recording that in the cash outflows. Then we have what we call rent payable. The meaning of rent payable, meaning it is the business meant to pay the rent. Maybe the business has no permanent premises and just rents where it operates from. Then we have what you call commission payable, meaning maybe your customers have done a good work, and then you have to pay commission to them for their good work, meaning you're going to incur money, you're going to spend the business money, and that is called a cash outflow. Then we have what we have some other here. What is it is electricity bills, salaries and wages, and telephone charges. These are all examples of cash outflows. So all transactions that you're going to be seeing spending out money in a business, like business spending out money, you're going to be recording that in the cash outflows. That is the third component of a cash flow statement. Okay, then I gave you a note here. We have a note here. When preparing the cash flow statements, we have transactions that we don't include. But before sharing that, let me just read for you this note. We have a note here. All transactions in cash form that make the business spend or lose cash are all recorded as cash outflows. As I've mentioned it before, that all transactions that are going to make the business spend out money or lose out money, we record those transactions in cash flow, in cash outflows, in that column respectively. I'm going to be showing you the format. Then the very last component of a cash flow statement is what we call the net cash position. Now, the net cash position just means the difference between the cash inflows and the cash outflows of a business. Let me give an example. If the business has incurred, let's say it has received over 1 million, let's say 1 million in a given, let's say in this month of January, and then it has spent out, let's say 500,000 in the same month, meaning we're going to get the 1 million minus the 500,000, and it is going to be our net cash position. So the difference between the cash inflows or money received and the money spent out in a business is what we call the net cash position. Now we have different kinds. We're going to be finding different kinds of net cash positions. We shall be having a surplus net cash position and a deficit net cash position. So a surplus net cash position means it is when the cash inflows are greater than the cash outflows. If a business earns more money than the one it has spent out, meaning it is going to be having a surplus net cash position. Then you're going to be also having a deficit net cash position. Here it means that when the business has less of the cash inflows than the cash outflows. In this regard, it means that the business has spent more money outside, or it has lost more money than the one it has gained or it has gotten from its operations. That is the last component of a cash flow statement or a cash budget. Okay, now when you're preparing a cash flow statement or a cash budget, I told you that we have some other expenses we don't include. You're going to be finding them in questions, but if you find them, they are just tricking you, so you should be very keen on that. So if you remember very well, we are dealing with cash flow statement from the word cash. So anything that is not cash is not recorded in the cash flow statement. We have a note here, an NB. What should not be recorded in cash flow statement or cash budgets? All non-cash transactions are not to be recorded in the cash flow statement, meaning any transaction that is credit that didn't involve cash is not recorded in the cash flow statement. If you record it there, meaning you're losing it out. So we have examples here. We have credit sales or goods sold on credit. If a business sells off goods on credit without involving cash, we don't include that in cash flow statements. Don't confuse it with, they say, receipts from debtors, meaning money paid by a person who took goods for credit, meaning he has paid cash. But if he just purchased the goods without paying the cash, we don't include that. It's called a credit sale. Then we have debtors. Then we have donation in kind. Now, the meaning of donation in kind means it means the money received. Let's say donation means any support given to a business or an organization. It can be in form of cash, it can be in form of equipment, and many more. Now, a donation, if it is in form of cash, it becomes a cash inflow. But donation in kind, it means it is a donation, but it wasn't in the form of money. Meaning, let's say it is a school, and let's say an OB donates computers worth 5 million to the school. That is what we call a donation in kind, meaning that is he donated the computers, not money. So if you find such a question, you don't include, because it is a donation in kind, not cash. Here we're dealing with cash. If I donate 5 computers to my former school worth 5 million, meaning I haven't given them money. I've given them computers worth that money, meaning we don't record that in the cash inflows or the cash budgets. Then we have what we call credit sales. Then we have what we call depreciation allowance. Now, the meaning of depreciation allowance means it is that loss of value of stock. If you buy any asset, if you buy any equipment or machinery, if you use it for over time, it gets depreciated. Take an example. If you buy a computer or printer to be used in your stationery and use it for, let's say, 1 month, and you want to sell it off, you can't sell it off at the same price you bought it, meaning it is depreciated. So you're going to be finding these allowances given in question, but we don't include them in cash flow statements because they are not in cash. No one can track these. Okay, then we have what we call drawings for personal use. Now, the meaning of a drawing is any expense made by a businessman in an enterprise. If you own a business and you withdraw, you take out money for let's say personal use. Let's say you get money and go buy a gift for your kid. It is called a drawing for personal use. We don't include that in a cash flow statement. But drawings for office use are recorded in cash flow statements. Then we have what we call receipts in businesses. You're going to be finding questions like, or entries like, maybe a thief broke into the business and stole goods worth this amount. We don't record that because cash flow statements they're also called projected statements. We don't include that in cash flow statements because they are not expected, or they are untold. They are unforetold. You can't tell them. So anything that is not foretold, we don't record that in cash flow statement. Then we have what we call uncertainties. Let's say floods, landslides, thunderstorms, and all that. Then we have many of them. We have surprise cash. If let's say a business, if you own a business and they give you surprise cash you didn't expect, that is also not recorded in cash flow statements. Surprise cashes, surprise gifts are not recorded in cash flow statements. There are many other transactions, or there are many expenses I can share out about what should not be recorded in cash flow statements, but for now those are some of the examples. Okay, now we have an example here